Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you on Wednesday, April the 6th, the year's 2022. Let's talk trading. Open, high, low, close. These videos are for educational purposes only. Your results may differ from mine. Okay, keeping it simple. Horizontal lines. The previous days, open, high, low, close. You put those four horizontal lines on the chart, you might be surprised at the number of trading opportunities you get. Now, if you look here early in the day, usually the previous day's close is the current day's open. It might be off by a pip or two, except on Monday, the difference between Friday and Monday could be greater. But the opportunities to trade these horizontal lines still exist. So right now, I have it on M30. Let's just switch it to H1. And you can see, if you just follow the H1 candle color, when it's crossing in the direction it crosses the first horizontal line it comes to, more often than not, you're going to get an opportunity to take profit. Sometimes it's very small, like here, and then going south here, but you can see here going north was very profitable. Here, going north and south was profitable. Now, in the early session, the Asian session and early London session, you can see the range is slightly muted, but there were still opportunities almost every hour. There was none here, none here. Then it took this big launch. So without saying it, this is the wick zone. These shaded areas. And as I had mentioned before in, I believe, yesterday's video about trading plans, or maybe it was Monday's video about how do you pick a trading plan or a method and then develop it. You put a trading plan around it. So the thing about this is you don't want to miss your opportunity, because if you didn't get this opportunity here, which would have been, let's see, 1, 2, 3, 4, 5 hours ago, then on this particular pair, you probably wouldn't get a trade for the day. But then again, we still have, almost 8 hours left in the day. Who's to say that it doesn't come down here and reverse, or come up here, reverse, or break through either the previous day's high or previous day's low? Now, there's one thing that's slightly interesting. You can bring this down. Instead of using a daily, you can bring this down to other levels. Let's see if I remember correctly. I believe it's this one. I'm using TROHL5 indicator for this, and it says my period 1 day. You can move it down to the 4-hour bar. And you can see here which way to trade based off the previous H4. So previous high, previous open, previous close, previous low. And then if you look at the H1, I think I have something, another setting in here I need to switch. Those lines start at bar true. There we go. So this is very simple, very basic method. And as I've mentioned, probably bordering on ad nauseum. The reason that you enter this trade has nothing to do with what happens after you enter the trade. So once you put that method in there, now you've got your other two legs of that three-legged stool that we've talked about, your risk management. How much are you willing to risk? And your brain management. Can you follow the method? Can you make sure you employ your risk? That's the biggie. So by switching this to H4, you can see that during this hour, there was an opportunity. During the last hour, there was one, small one, but there was a couple where this one, there really wasn't an opportunity. But that's not exactly true because this area here, 1, 2, 3, 4, this is the previous H4, so you would have had to take the trades off of here. But so far this hour, we had one trade that triggered. Remember the previous close, it's the current open. So just moving away from the open. There was opportunities. So we have this trigger line would have been at 96, at a high of 99, opportunity to take a couple of pips. Probably had to take them quickly. We can take a look here. And see, so there's an opportunity there. Now the question is, would you have taken this second trade? And if so, would you have popped out or would you have stayed in the trade? Now, since I'm talking about wick zones, what's really interesting is it's fractal in nature. So you can take those wick zones up and down the time frames. And what I mean by that is, if you look at this candle here, you can see it broke that high. There was an opportunity. And these are 1 minute candles. You look at this candle here, you see it broke that low. This candle actually gapped up. No trade. This candle here would have probably been a no trade because it had gapped down. But you can see how on some of these candles, such as this one, it broke the high, broke the low through the wick zones. And what you can do there is not use them for entries, but decide whether or not you want to take profit. Because if it breaks that wick zone here, and it broke one here and starts coming the other way, and you're in profit, and just start to take that profit off the table. And it might only be a pip or two, especially when trading is really slow, or sometimes when it's really fast, because you might have 5 pips and the next thing you blink, you only have 1 pip. And Walmart and I talk about it all the time, where it might be up 5 pips, you punch out, you look at your trading ledger, it only gave you 2.5. The market moved, and there's nothing you can do about that. So a lot of times when price is moving, steadily moving up in my favor and I'm long, I'll look and see how much time's left, and I'll just punch out. Or if I see a 1 ball, if I'm using a 3-level ZZ, I usually punch out, because more times than not, and I've related this, it seems like when I'm in the trade and a 1 ball happens, price just likes to stop and reverse. Sometimes I can sit there and wait for the candle to close, but other times I just don't want to give back that profit. So I have these other indicators on the chart, but the focus is just on these 4 horizontal lines and how often you can take a trade. Now, let's just put this wick zone back to daily. And let's set it at 1 hour. And let's just take a look at some of the other pairs that other people might trade. The euro, you can see, once again, there was opportunities to trade. Now, if you're a beginner, you kind of want to stick with the H1 or M30 candle color. If you're more experienced, then you might go all the way down to M5 and catch some of this price action, or even M1. Okay, let's take a look at the pound yen. You can see here, once again, opportunities to trade out of that upper wick zone. Okay, let's look at the dollar yen. You can see here, opportunities once again. And the other thing is, when you're just looking at the chart, you can see we had 1 close below and all these other closes above. Price came here and left the zone. Once again, you don't know what's going to happen next. You put your stop loss on and you take the trade, and it might smile upon you or it might not. You just don't know. Okay, let's look at the pound Swiss. I'm sorry, the dollar Swiss. So as you can see here, you had to get in early to get that one. How about the euro yen? One of my old favorites. Now here's one where you can see in the first part of the trading day, this doesn't really look that profitable. But then now in the London and then New York sessions, it's when the action happens. Dollar Canadian moves to be ahead. But then, we looked at some of these pairs. You can see here, the range is not that high. So that's one of the reasons why I don't trade the dollar Swiss franc. It just doesn't have the range. So, fellow traders, I hope you maybe learned a little bit more about, using your method, whether it's the wick zone or whatever, but just knowing that it really doesn't matter the method, that the reason is you enter, it's all what happens after you enter, because it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.